Welcome to the Deep Dive, where we get you up to speed fast. Today, we're digging into Amphenol Corporation's second quarter 2025 earnings call.
That's right. We've listened to the whole thing. CEO Adam Norette, CFO Craig Lampo, key players.
And our goal here is simple. Cut through the noise, extract the most critical insights for you, especially if you're an experienced investor keeping tabs on APH. Basically a shortcut to getting informed.
And you could really feel the optimism on that call. Management kept saying things like, outstanding results, much stronger than expected.
Yeah, it wasn't just hype. The numbers really back that up. We're talking record sales, record GAAP EPS, record adjusted diluted EPS for Q2.
Absolutely smashed records. Let's put some figures on that. Sales hit $5.65 billion. That's a new high.
And earnings.
Also records. GAAP diluted EPS landed at 86 cents and the adjusted figure 81 cents. Both records.
And the growth rates themselves are, well, pretty staggering. Year-over-year sales, up 57% in US dollars.
56% in local currencies. And maybe most importantly, 41% organic growth. That's huge.
41% organic. And it's accelerating too, right? Sequentially from Q1.
Yep. Up 17% quarter over quarter in dollars, 16% local currency, and 14% organic sequential growth. Serious momentum for a company this size.
Incredible. What about orders? Keeping pace.
Orders were also a record, $5.523 billion. That's up a strong 36% year over year.
Okay, 36% year over year, sequentially.
Up 4% sequentially. So the book-to-bill ratio came in just under 1 at 0.98.
So shipping almost everything they're booking shows incredible execution, really.
Exactly. They're managing that demand pipeline extremely well.
And the margins. I mean, this is where things get really interesting, I think.
Oh, yeah. GAAP operating margin hit a record 25.1%. That's $1.419 billion. And that includes about $29 million in acquisition costs.
Okay, so back those acquisition costs out, and the adjusted number is?
An even more impressive record.
Yeah.
25.6% adjusted operating margin. $1.448 billion.
Wow. 25.6. How does that compare historically?
It's a massive jump, up 430 basis points from last year.
430 basis points.
And 210 basis points just from Q1. It's mainly driven by just really strong operating leverage on those significantly higher sales volumes.
So they're getting more profitable as they grow. Any drag from acquisitions?
Only modestly offset by acquisition dilution, they said. It really shows a fundamental shift in their profitability.
So beyond just selling more stuff, what's driving that margin expansion? How are they pulling it off?
Well, management talks about the Amphenol style. It seems to boil down to really disciplined cost control, a shift towards selling more high-tech products across all their markets.
Okay.
And just an incredible ability to scale up operations efficiently. You know, execute.
Right. And the cash flow backs that story up.
Absolutely. Record operating cash flow, right. $1.417 billion. That's, get this, 130% of net income.
130%.
And record free cash flow, too, $1.122 billion, which is 103% of net income. Management called it excellent. And frankly, it's hard to argue.
Okay, let's unpack this a bit more. Can we look at the segments year over year, see where that growth is really coming from?
Sure. Communication Solutions was the real monster segment this quarter. Sales of $2.911 billion.
Which is up how much?
Up 101% in dollars and 78% organically. Just massive growth. And the margin there was 30.6%.
30.6% margin in Comm Solutions. Okay, what about Harsh Environment?
Harsh Environment Solutions brought in $1.445 billion in sales. That's up 38% in dollars, 18% organic. Margin was 25.2%.
Still very strong growth and margins. And the last one?
Interconnect. Sensors and Systems. $1.295 billion in sales, up 16% US dollars, 14% organic, and the segment margin there was 19.5%.
So while comms was the standout, really solid growth across all three segments, that diversification is clearly working.
Exactly. It shows the breadth of their strength.
All right, shifting gears a bit, let's talk balance sheet, capital allocation. What did they say about taxes, debt?
Tax rate was 18.3% a GAAP effective rate and 24.5% adjusted.
Okay. And debt levels?
Total debt ended at $8.1 billion, but net debt was much lower at $4.8 billion. That gives them a net leverage ratio of just 0.9 times. Very comfortable.
0.9 times, so plenty of flexibility there. Any major financing activity?
Yeah, during the quarter, they did a $750 million U.S. bond offering and a 600 million euro bond offering.
Okay.
And importantly, they mentioned no outstanding borrowings under their credit facilities. So strong liquidity position.
And they're putting that capital to work for shareholders too, right? Buybacks, dividends?
Yep. They bought back 2 million shares in the quarter Average price around 78.
2 million shares.
Add in the dividends, and they returned about $360 million to shareholders just in Q2.
Okay, makes sense. Now, acquisitions are a big part of the Amphenol story. Any recent deals?
Yes, they closed the Nardomingtek acquisition in May. It adds about $120 million in annual sales.
What does Nardomingtek do?
Primarily active RF and microwave components, mainly for the defense market. They paid around $300 million for it. Management calls it a reasonable multiple.
And how does that fit strategically?
It fits well. Complements their existing RF interconnect business and their active RF components, strengthening their defense position. It follows other similar deals like XMA and Q Microwave.
Right. And management really emphasized acquisitions as a core competency, didn't they?
They did. They called their ability to find, execute, and integrate these deals a core competitive advantage. And they've done a lot, 15 or 16 companies, including big ones like CIT and Andrew, just in the last, say, 2.5, 3 years.
That's a lot of integration. How do they make it work so well and drive profitability improvements consistently?
It seems to come back to that Amphenol style again. They have a playbook. They leverage their operational discipline, their distribution, their customer relationships. It's not just about buying revenue. It's about enhancing capabilities and then plugging those businesses into their efficient operating model.
Creating value beyond just the initial purchase.
Exactly. Compounding value.
Okay, let's pivot to the market trends and the outlook by segment. This is where that AI story really starts to emerge. Let's start with defense. That's about 9% of sales.
Yep, 9%. Strong growth there too, up 25% in dollars, 18% organic. Pretty broad-based growth, driven by more electronics content and defense systems. They expect a modest sequential increase in Q3.
Okay, commercial aerospace. Smaller piece, but 5%.
5%. Benefited from that CIT acquisition, but also expanding content per plane. Sales up 50% dollars, 8% organic. They're guiding to low single-digit sequential growth in Q3. Healthy trend there.
Right. Now, industrial, that's a bigger chunk, 19% of sales. How did that look?
Really robust growth. Up 25% dollars, 12% organic. Good performance across the board. Alternative energy, medical, instrumentation, factory automation, even industrial EVs.
And geographically?
Organic growth everywhere, they said, including double digits in Europe, which is encouraging. This was actually the third quarter in a row of year-over-year organic growth for industrial.
Third quarter. That shows some real underlying strength, doesn't it?
It does. It's broad and sustained. They expect a slight moderation in Q3 just due to normal seasonality, but the trend is definitely positive.
What about automotive? That's 14% of sales.
Auto grew in all regions, up 10% dollars, 8% organic. They do expect slightly lower sales in Q3 because of the usual summer shutdowns in the industry.
But focus on design wins for the future.
Exactly. Management stressed that point, looking beyond the immediate quarter.
Okay. Communications networks, 11% of sales. That one saw huge growth, right? Mostly acquisition driven.
Yeah, massive dollar growth, 143%, mostly from the Andrew acquisition.
Yeah.
But still very strong organic growth too. It's 16%.
16% organic. What's driving that?
Increased spending by network operators, wireless equipment makers, just continued investment in communications infrastructure. They expect sales to stay around these strong Q2 levels in Q3.
Okay. Mobile devices. Only 6% of sales, but how did it do?
Surprisingly strong, actually. Up 14%, both dollars and organic. Driven by smartphones and laptops, they see a high single-digit sequential increase in Q3.
Interesting. Okay, now for the big one. IT Datacom, 36% of sales. This was the real powerhouse, wasn't it?
Absolutely the powerhouse. Incredible growth. 133% year over year, both in dollars and organically.
133% organic growth. What fueled that?
Primarily accelerated demand for AI applications. Plus, their base IT Datacom business was also robust.
And didn't management say they actually shipped more than expected, especially for AI?
They did. They said they outperformed even customers' very high expectations for AI product deliveries. They shipped substantially more than planned, even pulling in a modest amount of Q3 demand into Q2.
How much of that growth was AI?
They said roughly 2/3 of the IT Datacom growth, both year over year and sequential, came directly from AI.
2/3. That's significant. So what does that out-execution mean? Does it mean Q3 will be weaker?
Well, they're guiding for IT Datacom sales to moderate sequentially in Q3, down mid to high single digits, specifically because of that pull forward and stronger than expected Q2 execution.
Okay, so a bit of a timing shift.
Right. But the key message was that the underlying demand, especially for AI infrastructure, remains exceptionally strong. It really just highlights their ability to ramp up and deliver when these huge demand spikes hit.
Okay, so putting it all together, what's the official outlook for Q3 2025?
Assuming current market conditions, constant currency, They're guiding for sales between $5.4 billion and $5.5 billion.
5.4 to $5.5 billion. And adjusted EPS.
Expected between 77 cents and 79 cents.
So even with that IT datacom moderation, what does that imply for year-over-year growth in Q3?
It still implies really impressive year-over-year growth. Sales up 34% to 36%, and adjusted EPS up 54% to 58%.
54 to 58% EPS growth year-over-year in Q3. Still very strong numbers.
Absolutely. And one more point on outlook. Capital spending is going to stay elevated, higher than their usual 3-4% of sales.
Why is that?
Continued investment to support all that growth, especially in IT datacom. They stress this isn't speculative spending. It's backed by customer visibility and future commitments.
Got it. Okay, let's bring this back to the investor context. That operating margin hitting 25.6% adjusted, that's above their old target, right?
Yeah, analysts jumped on that. Their historical target was a 25% drop through on incremental sales. Hitting 25.6% overall margin is, as management put it, an amazing achievement.
And they attributed it to
exceptional organic growth, selling more high-tech stuff across all markets, and that disciplined cost control, the Amphenol style.
But what's the new target? This seems like a really big deal for how you think about the company's future profitability.
It is a big deal. They now expect margins to stay meaningfully higher than that old 25% level. And the new target for converting incremental sales into operating income is approaching 30%.
Approaching 30% incremental margins, that's quite a step up.
It's huge. It reflects, more technology in their products, the value they provide, and just consistently strong execution. It means more of each new dollar of sales should hit the bottom line going forward.
Now, that AI growth, was there concern on the call about it being a bubble or just a temporary surge? That pull-in effect we discussed?
That was definitely a key question. Management tackled it head on. They acknowledged the pull forward from Q2, estimated around $150 million pulled from Q3.
Okay.
But they were adamant this is not peakiness. That was the word they used. They see continued momentum.
So they believe AI demand is durable.
Very much so. They framed it as the early innings of the adoption of AI on a broad basis. They highlighted their broad product portfolio, their tech depth, their ability to ramp globally. They're basically saying they're the first phone call when companies design next-gen AI systems.
That suggests real staying power.
Right. And they also stress the AI business is very broad. It's not just one or two big customers. It spans web-scale companies, data center builders, OEMs, even chip companies.
So less concentration risk. Might be lumpy quarter to quarter, but the medium to long-term trend is positive.
That was the clear message, especially with AI driving 2/3 of that massive IT datacom growth.
And underlying all of this is that execution point again, achieving 41% organic growth across the board.
Management kept emphasizing that, calling it a truly outstanding performance by the global team. It wasn't just about sales. It was hiring, automation, testing, building new facilities, even shifting geography to handle geopolitical stuff.
Right. That Amphenol style isn't just about cutting costs. It's about smart resource allocation.
Exactly. Not just throwing money at the problem, as they put it. That efficient execution is what lets them turn that growth into strong margins and cash flow. Their view is demand seems to be strengthening almost everywhere they operate.
And they keep outperforming even that strong demand.
That's the narrative. Consistent out execution.
Okay. Let's move to our This Is Not Financial Advice segment. Time for a potentially bold but fact-based idea.
All right, let's hear it. The setup seems pretty clear. Record quarter, new higher margin targets, prime position in AI infrastructure.
Exactly. Amphenol looks like it's hitting its stride. Yes, Q2 had some pull forward, but management sounds incredibly confident about being in the early innings of AI. That suggests a long runway.
They're not just benefiting from a trend, they're executing exceptionally well within it. Critical enabler status, almost.
So here's the idea. Basic starting point. Consider a long position in Amphenol equity, ticker APH. Standard enough.
Okay.
But to potentially capture more upside, especially if the market starts fully pricing in that new approaching 30% incremental margin target and the long-term AI story, maybe add a moderately out-of-the-money call option.
Adding some leverage.
Right. Something with an expiration well out, maybe into 2026. It plays on that management confidence in durable AI growth and their proven ability to hit higher profitability targets.
So you're betting on a potential re-rating of the stock as the market digests this new margin potential and the longevity of the AI cycle, right, even if there's some near-term lumpiness from that Q2 pull forward.
Precisely. It's leveraging their execution story and the AI tailwind.
Interesting play. Captures that potential step change in profitability.
Okay, let's wrap this up. To recap, Amphenol Q2. Truly exceptional. Record sales, record EPS, really impressive margin expansion.
Driven by that strong execution, strategic positioning in IT datacom and AI, plus solid performance across their diversified markets and a successful acquisition program.
And that ability to consistently out-execute demand, coupled with the new target of approaching 30% incremental operating margins. Well, it raises a key question for you, the listener.
Yeah, the question is, how much of this operational excellence and future growth potential, especially in these early innings of AI, is already reflected in Amphenol's current stock price?
Something to think about. And remember, this discussion was purely for informational purposes. It is absolutely not financial advice.
Always do your own homework. Consult with a qualified financial professional before making any investment decisions.
We hope this deep dive gave you some valuable insights into Amphenol's quarter. What stood out most to you from their call? Definitely worth digging deeper into these trends.